Hello guys, what is happening and welcome to tonight's live stream. So you know what, tonight's live stream is going to be fantastic because I am bringing you this article which is about 2008, which nobody really knows about. Like, armed with this, you know a lot more than anybody out there. As we know, most people, when you think of 2008, think of the subprime crisis associated with it. They think of the Big Short. They think of 99 Homes, which was obviously correct, the bad things that happened following this crisis. But was this crisis actually built on subprime borrowers, or was it your typical mom and pop landlord, your prime borrower, your borrower with good credit? That's what we're really going to look at in this. So please like the video, it greatly helps, and subscribe if you haven't done so already, and leave a comment of what you think of this, because I think it's really important to go over this as we head into a very similar style crisis, albeit not exactly the same. The conditions aren't exactly the same as 2008, but the outcome is going to be very similar. And the reality is a lot of people are going to lose their home and get foreclosed on, and that is just the way it's going to go. There has been mad, rampant speculation in the market, as we know, and that bleeds out at some point or another. And another thing, guys, which we'll probably go over in a future video, is I'm noticing Airbnb prices are on the way down. So average nightly prices, I've mainly been looking at Phoenix, Arizona, and Palm Springs, California, Las Vegas, and you're starting to see the prices come down a lot. So it's very, very interesting. So we've got to wait a couple of months and see if that's actually a trend, and we'll go back into the Airbnb data. But anyway, let's dig into this. And this comes from the National Bureau of Economic Research. The US foreclosure crisis was not just a subprime event, and this was released in 2015. And you never really heard anybody talk about it back then. So this chart is really interesting. What you can see is it goes from 2004 to 2012 across the entire crisis period. This includes the obviously run up in prices and everything, although really that started around 2002. So I guess there's a couple of years you missed. But you can see how after 2006, it slowly starts to rise how many people are being foreclosed on, and then it just absolutely explodes and just keeps heading up. And it was in 2008 where it spiked up there. That was really when you had obviously the collapse of Lehman Brothers, and the full-on financial crisis actually came to the forefront of the mainstream image. Because what we tend to forget about this prior crisis is before Lehman and everything like that, everything was kind of rosy. The stock market was going up. It was really when Bear Stearns went in July, that was really when the stock market started to get jittery. And obviously it collapsed in 2008 and continued to go down after the collapse of Lehman, and the full-on widening of credit market spreads and everything like that meant that it was very, very difficult to get financing. Nobody wanted to lend, and if they did lend to you, it was at an astronomically high interest rate. The thing that people don't tell you about that is the Federal Reserve, the Bank of England, the Bank of Canada, all these central banks were cutting rates during that period. They don't tell you that interest rates, if you wanted to try and buy a investment property, good luck with that unless you've got like a massive amount of collateral. The thing is, the availability of cheap money that has been around for the past 20 years, people have just become used to it almost. But there have been significant periods where credit was really, really tight. And that really affects a market a lot, because it's, as I've said in previous videos, you know, when you have these type of busts, there will be a number of people who would love to buy a house during that bust, and they can't get a loan. And that is because the banks are dealing with so many credit losses from what we're seeing on the screen here, which is the foreclosure crisis that happened. So you can see how prime mortgage borrowers was twice as many as the subprime mortgage borrowers. So you can see that twice as many foreclosed home as subprime borrowers. So it's not really a fair argument to say that it was mostly a subprime crisis. It wasn't. It was actually just speculation, mad speculation. And that is the thing that I want to kind of go through with this. And the reason why I'm bringing this up right now is a lot of people are saying right now, in the US especially, that this time is different because banks have been really strict with their lending. Okay. Let's say that's true. But again, look at this chart. What does this chart tell you? This chart tells you that the prime mortgage borrower, i.e. the one with good credit that the bank is willing to lend to, is the one that actually went bust the hardest. And the fact is that there's more prime mortgage borrowers than subprime mortgage borrowers, evidently. That's always going to be the way. I think it makes up like 15%, it says in this article, or 10% of the borrowers. So yeah, there was a lot of subprime homes being foreclosed on, but not as many as the people with good credit and supposedly quote unquote good jobs. So just remember that, because you know everybody right now thinks that they're going to be okay. It is this sort of normalcy bias is prolific right now. It's right in front, and you can see everybody is kind of thinking, this will not affect me. Nothing will go wrong. You know, I rent out my properties, so I'm okay. Okay, but what happens when your tenants, they lose their jobs and don't pay anymore? And then you've got to try and get them out. And then maybe if you have 4 or 5 investment properties and 2 or 3 of your tenants lose their job, you can't afford to pay the rent on behalf of them for 2 or 3 people. And this is the thing, the banks have just got riskier and riskier with their lending, even though the perceived risk of the prime mortgage borrower is less because they have a good credit score and because they hold down a good job. But that doesn't mean that they're not going to lose their home. And that's exactly why I'm going through this today, because there's a lot of things about the 2008 crisis that people just don't really know and is in this article. And you know, it's you even see like really smart people, in my opinion, who even still call it a subprime crisis when it was more of a prime crisis than a subprime one. So anyway, let's see what they're saying here. The crisis began in the subprime mortgage sector, but twice as many prime borrowers as subprime borrowers lost their homes over the full sample period. Many studies of the housing market collapse of the last decade and the associated sharp rise in defaults and foreclosures focus on the role of the subprime mortgage sector. Yet subprime loans comprise a relatively small share of the US housing market, usually about 15% and never more than 21%. Many studies also focus on the period leading up to 2008, even though most foreclosures occurred subsequently. It's another interesting point there. In a new look at the US foreclosure crisis, panel data evidence of prime and subprime borrowers from 1997 to 2012 provide new facts about the foreclosure crisis and investigate various explanations of why homeowners lost their homes during the housing bust. They employ microdata that tracks outcomes well past the beginning of the crisis and cover all types of house purchase financing, prime and subprime mortgages, FHA, VA insured loans from small or infrequent lenders, and all cash buyers. Their data contain information on over 33 million unique ownership sequences in just over 19 million distinct owner-occupied housing units from 1997 to 2012. So this is a huge study that was done. So this is not a small thing. This is absolutely massive. And of course, at the time, you heard nothing about this when this came out. And still today, nobody really knows about it. So, and you know, it was one of the things that I covered ages ago on one of the very first podcasts I did before I did live streams and stuff. And a lot of people emailed me about it, and that's why I thought, you know what, I need to do this again because I didn't cover this here on the channel. But yeah, so it goes on to say, and this part is really, really interesting. The researchers find that the crisis was not solely or even primarily a subprime sector event. It began that way, but quickly expanded into a much broader phenomenon dominated by prime borrowers' loss of homes. There were only 7 quarters, all concentrated at the beginning of the housing market bust, when more homes were lost by subprime than by prime borrowers in this period. 39,094 more subprime than prime borrowers lost their homes. The small difference was reversed by the beginning of 2009. Between 2009 and 2012, 656,000 more prime than subprime borrowers lost their home. Twice as many prime borrowers as subprime borrowers lost their homes over the full sample period. So it really started off with obviously the weakest people losing their homes, which is the subprime. And really this is where it will start right now, guys. This is exactly where it will start right now. You'll have the weakest hands in the market, which will be the subprime borrowers who will default first and lose their home. And then after that, that eventually translates down the line, and then you get the prime borrowers defaulting and losing their home. So, you know, it's going to happen. And because of the run up in housing prices and the mad speculation and the leveraging on leveraging on leveraging that people do, that really changes things, because that's what makes it a bubble. When you have this mad speculation, this sort of brain mentality that people have, is that I can't lose, it's housing never goes down. They said these exact words in 2008, and everybody right now is like, this time is different, this time is different. And, you know, as we've discussed before, one of the main reasons that Canada avoided 2008 was the fact that the private business debt was low and stable. And what did they do? What did they decide to do at that moment? They let them borrow like crazy after that 2008 event, and they did, and that created a private sector debt bubble that now eclipses the size of the one in the US in 2008. So, you know, that was the reason how Canada avoided 2008, because without that private sector, that high private sector debt when the financial crisis hit, when credit spreads exploded, when nobody could get a loan, be it a business or a household, and that meant that, you know, they were screwed. And a lot of the companies in the US, because the private debt was so high, inflated from obviously the dot-com crash all the way to 2008, it was much, much larger. A lot of businesses were surviving on the free money and the cheap money that they were getting from the banks. And then the banks said, nope, no more cheap money. You know, there is a great it's a film actually called Princess of Versailles or something like that. I forget the name of it, but anyway, watch that, because in that it's about a timeshare mogul multi-millionaire, and they're filming the whole documentary and well, it's not a movie, it's like a documentary, but it's about 2 hours long, and they're filming that. And then 2008 hits, and then they continue filming as that goes on, and they begin to lose everything. And I never forget the timeshare mogul's name. I can't remember, but I'll never forget what he said, which was, they got us addicted to cheap money and then they just took it away. That's what he said. So you know what? It is just going to be like this time around. Apart from here in Canada, you've now got that private bubble. You've now got that private sector debt bubble that you didn't have back in 2008. So they were able to get out of 2008 by inflating a private sector bubble, as well as further inflating the household bubble. if you'd had that private sector bubble, the unemployment would have gone much higher in Canada for way, way longer. And then you would have had the same amount of people lose their homes and all the other effects that you had in Ireland, in the UK, in Spain, Portugal, the United States, because it wasn't just the US. That's the other thing that a lot of people, it affected loads and loads and loads of markets. It was only a few places like New Zealand, Australia, and Canada that managed to dodge it, and they didn't really dodge it. It was a kicking the can down the road event where they just said, you know what, we'll just inflate some more bubbles. Because at the end of the day, guys, the politicians, the bankers, all these people, they just think in a 4-year or 5-year election cycle. They don't really care about the bigger picture. So if they can think, well, we inflate this bubble and then, you know, I'll pass the buck on to whoever next is the leader. That's what they think. So anyway, that's my kind of 2 cents on that. The authors suggest that one reason for this pattern is the number of prime borrowers dwarfs that of subprime borrowers and the other borrower/owner categories they consider. The prime borrower share averages around 60% and did not decline during the housing boom. Although the subprime borrower share nearly doubled during the boom. It peaked at just over 20% of the market. Subprime's increasing share came at the expense of the FHA, VA insured sector, not the prime sector. So the author's key empirical finding is that negative equity conditions can explain virtually all of the difference in foreclosure and short sale outcomes of prime borrowers compared to all cash owners. Negative equity also accounts for approximately 2/3 of the variation in subprime borrower distress. Both are true on average over time and across metropolitan areas. And you know what? This is an interesting junction to stop and take a second to think about negative equity. You know, loads of people are going to drift into negative equity. And one place I'd like to use as an example is places like Calgary and Edmonton, for example. So, you know, these are cities where a lot of people are risking and moving to and buying houses, and they don't understand the market. Obviously, they're just moving completely with FOMO and everything like that. In most cases, there are the odd one that have worked out, you know, we could sell this house here, buy like an apartment there, and then pocket the spread. But most people are just moving here and they're just overextending themselves. You know, same old, same old. It's always the same. People just do the same patterns. They don't change. I know we like to think the majority of people are smart and clued up, and I'm not sat on my high horse saying I'm the smartest person in the world, because I am not. But all I'm saying is that people act in patterns. The herd mentality persists beyond just the mania phase. It continues. So, you know, like those people who are coming out here, for instance, are at most risk of being negative equity. And if you're in negative equity, the probability of you losing the home shoots up through the roof. So you have to remember that, because that is a key component of it. So wherever you are, whatever market you're in, you can kind of peg to where most people have bought throughout 2021, and then you can figure out, well, when are those people going to be in negative equity? And then when that price drifts down to when those people are in negative equity, then what does that mean? That means the probability of foreclosure skyrockets. So, you know, that is a good way to look at the probability of people being foreclosed on, and a lot of foreclosures making their way onto the market. Now, foreclosures take time. They're not a quick process by any stretch of the imagination, and the courts are still clogged up right now, from what I hear from different people in that industry, of foreclosure industry. So, you know, and there's a lot of people actively hiring. If you're interested in a job, I mean, I don't know how people do this job, but they got to have like nerves of steel to do it, in my opinion. But there is a lot, if you Google and look around, there is a lot of jobs for people working at foreclosure management companies and everything like that, because I've looked. So yeah, and have a look where they're recruiting, because it's places like Alberta, it's in BC, so it's all these places which were the massive boom areas, of course. But you can just Google foreclosure companies, have a look where they're hiring, and you can see this all online. So it's all there. None of the other usual suspects raised by previous research or public commentators, housing quality, race and gender demographics, buyer income, and speculator status, were found to have a major impact. Certain loan-related attributes, such as initial loan-to-value ratio, LTV, whether a refinancing occurred or a second mortgage was taken on, and loan cohort origination quarter, did have some independent influence, but much weaker than that of current LTV. So basically, it was saying people taking out those higher loan to value ratios were the ones most at risk of being foreclosed on, which makes sense. The thing is that it's become so manipulated now that people have figured out how they can manipulate credit to get as much as they possibly can and leverage on real estate, that it has become a major problem, because the bank doesn't even know the LTVs really anymore. I mean, I was speaking to a mortgage broker a couple of weeks ago who was saying to me that a lot of the banks don't even check on both credit bureaus. I could not believe this. So apparently some of the banks in Canada, and I'm sure it's similar in the US too, some of the banks in Canada use TransUnion, others use Equifax. And apparently sometimes, a lot of the time, according to him, they don't check both bureaus. You could have a bank account on one bureau with a massive line of credit and they wouldn't even pick it up. Like, it's just ridiculous. But obviously now they're probably checking that more and more, because they're getting more and tighter on their lending right now. It's not like it was last year where they just give to anybody with a pulse, because it was the free money era and everything like that. Now it's a totally different thing. So it kind of, and that in itself, the bank not wanting to lend, that creates a big problem down the road for the housing market, because if banks don't want to lend, that slows down credit going into the market, that makes it more illiquid, and that leads to lower prices and whatever. But you know what? It's like we said, this isn't going to all happen. Like, people think this is all just going to, flood over and everyone's going to be buying houses for pennies on the dollars in 6 months, 8 months, 12 months. I don't honestly believe that. I think you're more looking at probably 3 years or so, something like that. I mean, who really knows how long it's going to take? It's just a guess based on what prior bubbles have took to birth. It really takes 3 to 5 years. And then it's based on what the central bank's intervention obviously is, where inflation goes, which looks like ever increasingly higher from here. So, I don't know. I just really struggle to see like people who are thinking like real estate is going to be my retirement and buying houses. I've seen a lot of that, and I just think, that is kind of mad right now, because I don't think it's going to be a great investment at all over the next 20 years or so. And that's really just the basis in the countries that are essentially shooting themselves in the foot: Europe, the UK, America, Canada, New Zealand. Australia is a little more independent, but still pretty bad. So, all these countries really have shot themselves in the foot. More neutral countries, I have a feeling that they're going to be the better places to invest. The author's findings imply that large numbers of prime borrowers who did not start out with extremely high LTVs still lost their homes to foreclosure. They conclude that the economic cycle was more important than the initial buyer, housing and mortgage conditions, in explaining the foreclosure crisis. These findings suggest that effective regulation is not just a matter of restricting certain exotic subprime contracts associated with extremely high default rates. So it's pretty interesting when you really think of that, because, you know, there's a lot in that article, you know, which is just kind of, you have to read it twice, really. And by the way, I've put a link in the description so you can go check it out. But obviously, there are a number of things that caused a lot of people to get foreclosed on. For the majority of people, it was the fact that they were overextended, or they were overextended. Their LTVs were pushed up, so they didn't have much equity in the property. Property prices started to come down. Remember, the foreclosures weren't that large by that point. And then it was only really a year, 18 months after prices started to come down that foreclosures started to rise. And that kind of coincides with the whole denial phase that you get in the bubble. At the end of the day, this is a cycle. It is really a cycle that we're in right now. And it's not over, and we're not in the final phase. We're in that denial phase. And, you know, it may last until next spring. It may last past next spring. But the thing is, the prices are going to be falling against that if they're still tightening rates, or even if they're not tightening rates, if the banks just simply don't want to lend, or they borrowed so many people from the future now that the chances are that at some point there's going to be a moment when sales start to decline naturally anyway, because less people are buying, because they were all buying when the mentality was supporting buying versus when it isn't. So I think it's interesting, because that denial phase is just kind of when everybody is sort of, it's a tense place to be in, and that's where we are right now. And that is why I'm like kind of super analytical of people's behavior and what different people think and what's really going on out there in the real world, because really you can pick up a lot from that. And, you know, it's like just seeing all the Airbnb prices that have come down in places like all these places where people went out and they bought tons of Airbnbs, you know. Are people cutting back already? Likely so. And that's going to have big impacts, big economics. There's just a lot going on, basically. So it's going to be crazy. We're going to continue to measure and listen to the pulse on this channel, as we always do. If you enjoyed this video, please like it. Thank you so much for supporting the channel, being here, watching the streams, listening to the podcasts. It's greatly appreciated. Check out some of the channels that I like in the description. Check out and go and read this article on your own time and see what you think and digest that for yourself. And I will see you guys on the next one. Please leave a comment, other things you'd like me to cover or whatever. I would love to hear from you. Thanks a lot, guys. Take care. Peace.